So for everybody watching, for those of you that don't know me, my name's Sean McAuliffe. I'm the Chief Marketing Officer here at Automotive Keys Group. Prior to this, I was actually the founder of International Key Supply, which was one of the companies that became International Keys Group. So I'm very familiar with having a small and then a medium-sized business and having to pay taxes. I was actually thinking about it when I was kind of prepping for this, that I don't actually remember the last time I got a tax refund. I'm sure a lot of people here are the same, right? So always a good problem to have when you have to pay a lot of taxes, but never a fun check to write. So the goal of this webinar here is to have some experts on to tell us about how you can potentially save on some taxes as a business owner. So Lil is the founder and CEO of Xendoo. I don't want to say too much, Lil. Why don't you introduce yourself and your company?
Thanks so much, Sean. Pleasure to be here and excited to have this chat today because uh, Xendoo is an online bookkeeping and accounting company. I'm a serial entrepreneur. I am not an accountant, although our company has the most amazing CPAs and accountants. And I feel the same pain that you feel when you write a check to the government and you wonder why do Fortune 500 companies not have to do it. And in all my years in business, I was like, why can't we save money like they can? And so that's what Xendoo does. We love to take great care of small business owners, and we do their books monthly so they can have the visibility to understand if they're making money. And then come November, everybody's calling Lewis because they want to lose all their profit and save the money on taxes for the new year. So we love it.
Awesome, awesome. And Lewis, why don't you introduce yourself, your history, and whatever else you say?
My name's Louis Goldenberg. I have about 34 years, 35 years of accounting experience. Been a CPA since 1991. I'm also a forensic accountant. I did some forensic work and due diligence. I've been with Xendoo since just after the start.
Nice, very nice. So, I guess, folks, if you have some questions, feel free to use the Q&A. We'll either answer at the end or I know we'll have a section at the end for Q&A, so it doesn't only have to be about Section 179, but this particular webinar is about the Section 179 deduction, which is a deduction that most of you can use to save money on your taxes. So go ahead and use the Q&A if you have questions. And then, like I said, we'll have a Q&A at the end. Otherwise, I think, Lil, you can take it away.
Thanks so much, Sean. So we're going to go through a couple of slides here, about 10, 12 minutes of talking through some things. And then we're going to open it up for Q&A. And while we're waiting to share screen, we're going to talk about Section 179 and beyond, because there's a lot of things that you want to do at the end of the year and be thinking about at the end of the year to utilize the money that you would normally pay Uncle Sam and invest it in your business. So, folks, let's get started. Section 179 and beyond. What does that mean? So, Section 179 is an immediate deduction on qualifying business assets. So the cap for that, and it was just recently brought back and raised, the cap for that is 1.25 million. And what you're going to do with it is you're going to use tax dollars that you would normally pay the government, and you're going to be able to use that to invest in your business. And we're going to talk through some scenarios about that. So let's talk about some of the things that qualify for it, right? So larger vehicles, 6,000 pounds and above. So box trucks, heavy duty vans, sprinters. A sprinter runs $90,000 to $100,000. And if you buy one of those, if it's going to be helpful to retool your business, you would want to buy one of those, provided that you have profits before the end of the year. So let me give you an example of how Section 179 works. Say you have $100,000 in profit in your business. I'm going to use easy round numbers. Say you have $100,000 profit in your business, and typically somebody's tax bill is 25 to 30% of what your profit is. So let's just say that you would owe Uncle Sam $25,000 of tax dollars. And instead of writing that check to him, if you go ahead and invest in this vehicle, you're going to be able to claim that $90,000, and that's going to reduce your profits in your business from 100,000 down to 10,000. And now it's going to reduce the amount of tax that you have to pay. And, those are the ways that you make Section 179 and tax loopholes work for you in your business. And at the end, Lewis will talk more of the technical details around some of that. We're also going to talk about bonus depreciation, which is much different than than Section 179 because you don't have to be profitable to use bonus depreciation. But Lewis will get into the technical side of that. So what are some of the other things that you can use for Section 179? So shop and field equipment, something as simple as maybe you need to retool your trucks and it's going to take $10,000, $15,000 or $5,000 for a particular machine that you want. You want to go ahead and make those purchases before the end of the year, provided that you have profitability and that it makes sense that you actually need it in your business, right? Don't buy it if it's not going to help you grow your business, obviously. But other things that are available for Section 179, software. If it is off-the-shelf software, not something that you've built for your business personally, but something that you can buy off the shelf. If it's a computer, a laptop, maybe a dispatch and scheduling system. So there's a lot of things when you think about what it takes to run your business and where the next growth is, and maybe you're maxed out. Maybe you have 2 trucks on the road, you're doing $250,000 a year or $400,000 a year, and in order to expand sales, you need that truck and you need the equipment in it. This is the perfect time of year to do that. Other things that you can use Section 179 for, certain things, certain leasehold and retail improvements, lighting, flooring, HVAC, outdoor signage for your shop. Maybe you want to just go ahead and redo the whole front of your shop and make that investment because now you're getting into AI safes or, any of the new technology. Maybe you want to, buy more inventory. We'll talk to Lewis about that in a couple of minutes and see, does inventory work in Section 179, or is that bonus depreciation, or what are the hacks and the way around that can really add money to your bottom line for you that you get to keep? So how does it all work, right? So the action plan for you to implement this in your business. One, kudos to you because you guys are on the call today. So that means that you're interested in this, you're thinking about it at the right time of year. The statistics say that the majority of small business owners do their tax planning in February and March of the following year. You can't take the deductions then. You have to take the deductions before December 31st. So kudos to you guys for being on the call today. So action plan, really simple. Identify potential purchases or expenses that you'd like to accelerate. And I'll talk about how do you accelerate expenses here in a minute. Then review your financials for your tax saving opportunities, review your financials for your profitability, because you need to have a target. Like I said, say you're $1 million business and you're, putting $200,000 to the bottom line. Well, that's the money that you would be paying tax on, and more than likely you'd have a $50,000 to a $60,000 tax bill. And that's the bucket of money that you want to turn into an investment fund for your business for the growth going forward. So you have to review the financials to see what that is. Then you want to ensure your purchases are completed by December 31st, 2025. And then always you want to make sure you have a great accounting company that sees the world as you do, that you should keep as much money as possible in your pocket and not in the government's pocket. So you want to hire a bookkeeper or accountant, depending on the size and stage of your business. Typically, if your business is smaller and still growing, early on, and doing, say, less than $400,000, $500,000 a year, then you're going to be really looking for a bookkeeper, cash basis accounting. We have those. If you're a business that's a couple million in size and maybe you have multiple trucks on the road, then that's where you're going to get into more accounting. The difference between bookkeeping and accounting is really a lot of what goes on with your balance sheet and how many loans you have and what kind of activity needs to happen on the balance sheet and the level of complexity. So we at Xendoo, we have bookkeepers and we have accountants, and we take care of businesses that are from a couple $100,000 in size up to about $50-$55 million in size. So as you're growing, we'd love to be part of that journey. Our contact is sales@Xendoo, and there's a number here if you'd like to schedule a free consult or chat with us. What I'd like to do at this moment is I want to give you, before I bring Lewis on, I want to give you a few other areas of tax savings that to think about. So maybe you don't want to buy equipment, or you don't need equipment right now or software right now. You can prepay expenses at the end of December for January. We just recently had a customer who did the same thing last year. They paid 6 months ahead of time because they're prepaying a lot of their expenses. So they roll their deductions in, provided it's 100% deductible, and then kick the can down the road for what they may have to pay next year in tax. So prepays are a big area. Bonus depreciation is a big area. And then the entity type that you are in your organization is a big area. And so with that, what I'd like to do is I'd like to open it up to questions as I bring Lewis on. Lewis has a lot of humility, and he doesn't really tout what he does for our customers. But I'll share. Lewis did the diligence when the Dolphin sold from Heisinger to Ross, so he was part of that big team of diligence. But more importantly, Lewis loves small business owners. And in his prior, day doing a lot of forensic work, he would work for the small business owner to rebuild books and take care of things when they were battling the IRS. So a lot of great knowledge in his head. He loves to read tax regulations, and he loves to save small business owners lots of money. So Lewis, I know you want to chat about bonus depreciation. I'm going to turn it over to you.
Yeah, thanks, Lil. So the one thing I want to say about Section 179 is that it's a great tax deduction, but it's limited, like 1.25 million, and you can only make so much money as a company. But it might even be more powerful is this bonus depreciation, which the Congress brought back to 100%. It's 100% now through 2030. So bonus depreciation is not limited. Like with Section 179, you can't take a loss. You can't go take a loss off of that. It gets carried forward. But bonus depreciation, you can take a loss. So if you want to get more tax deductions from your other income on your personal tax return, you can use bonus depreciation. But a combination of both is always good. I see we have a question. Somebody is asking, what kind of documentation do I need to claim Section 179 or bonus depreciation? And the answer is you really don't need any. You need proof that you purchased the item in the tax year. That's all you need.
Fantastic. Thank you.
Oh,
Sean,
wait, one other thing about inventory. So inventory would not be depreciated under Section 179 or bonus depreciation. Inventories, if you're a small business taxpayer, less than $30 million of revenue, and you file on the cash basis, which most small business taxpayers do, you can write off inventory as you purchase it because it's cash basis. If you pay for it, you can deduct it.
Does that mean, like, as a business owner, you can, like, these are locksmiths, right? They could stock up on a whole bunch of keys before the end of the year, a whole bunch of their supplies before the end of the year, and that comes immediately off their kind of taxable income?
100%. Yep.
Yeah. And what's the difference if
it's
you're
cost of goods sold? It's a purchase.
What's that?
Yeah, it's a purchase. It goes under cost of goods sold, even if it's not sold, because again, it's cash basis.
Got it. But for those that are on accrual or modified accrual, it's not the same, right? There's some different rules there.
Well, it depends. Modified accrual, you might be modified only because you have loans or because you have deferred revenue, but you could still do, you could still expense your purchases.
Got it. I actually had a question about the van example from the other day. And if anyone else has questions, feel free to put them in the Q&A. But question from the van example, is there a way in which you can kind of have your cake and eat it too by buying the van, but financing it? So I'm not actually spending the money, the cash today. Like, can you do that, or do you have to buy it cash under that when doing the Section 179 deduction?
Great question, Sean. It doesn't matter whether you finance it or if you pay cash. As long as you buy it, right, that's the purchase. How you pay for it is not looked at.
So I could, at the end of this year, for instance, I could buy this $90,000 van. I could put, let's say, $0 down, right?
Right.
And finance it over 5 or 6 years. And I would have paid, what, $30,000 in taxes roughly if I didn't buy the van. And now I can use that $30,000 to pay my loan payment on the van over the next couple of years that I just saved. Is that like?
Right, and you get a full tax deduction for the van because it's over 6,000 pounds. So that $30,000 that you're going to pay in taxes, you're using that much more wisely. I mean,
Yeah.
much more tax beneficial
Yeah.
to your business.
If it's a lease, is it the same, Lewis, or lease doesn't qualify?
Lease does not qualify. Lease, you just tax deduct the lease payments. Unless it's a lease where at the end of the lease you pay $100 and you own it, then that qualifies. But those kind of leases are, I don't know if that's
We do that
available.
we do that in our equipment, from some of our equipment sales. It's usually like $1 buyout or something at the end of the lease.
Right. In that case, it would be available for Section 179 or bonus depreciation. Yes.
Fantastic. Fantastic. Lewis, talk to us for a minute or so about right entity type, because I know that you take a lot of people that maybe started their business with a ROBS, or that they're a single member LLC, as filing as a Schedule C on their taxes. And when is the right time for them to move over to an S corp? And talk us through some of that, because sometimes business owners say, "Well, I don't want to be an S corp. I don't want to pay 2 tax returns." But do a little math of why the benefit outweighs that.
All right, so there's a couple questions there. So number one, if you have a ROBS rollover, you start a business with a ROBS rollover, you have to be a C corporation. So if you give some of your personal money also, and the ROBS gives money, make sure that it's set up properly, that some of the stock is issued in your name and some of the stock is issued under the ROBS. Then once the business becomes profitable, then you can get a business valuation, you can buy the ROBS out, and then switch the company over to an S corp. Because under a C corp, the only way you get money out is by salary, and that's really the highest tax rates. If you take a dividend, that's taxed twice, so I don't think you want to do that. But you want to try and get the best tax rates, which would be as an S corporation, which would mean that you take some of your money as a reasonable salary, and the other part of your money as a distribution from profit, and that's only taxed at normal income tax rates, not your employment taxes. So that's tax beneficial. Then a Schedule C filer, an LLC that Lo was talking about, once you get to be about $25,000, $30,000, then you want to switch to have that LLC taxed as an S corporation to again get the most tax benefit. Because the Schedule C, all of your net income is taxed at the self-employment tax rates, 15.3%. As the S corporation, really only about a third is taxed at those employment tax rates.
When you say 25 to 30,000, is that, what period is that? Is that profit?
That's the net income for the entire year. So once you feel as though you're going to hit that net income, then you can backdate the S election to January 1st of that year. You can always backdate the S election up to 3 years.
Yeah, and I mean, essentially any one of these locksmiths here, I mean, if you're not making $25,000, $30,000 a year as your primary, I mean, they should, most of them probably be considering an S election.
100%. And most
Tax
people,
beneficial.
most people miss it. We have 2 quick questions. One was, will there be a recording if I have to leave? Definitely. Sean and Michelle will be sending that out to everyone. And with their permission, we'll also send out an email that will have a link that if you'd like to schedule a free consult with our sales team, that you certainly can do that. If you'd like to have a tax consultation with Lewis, we do those at 15 minutes for $140. And so we can go ahead and schedule you with that. The second one is from Josh. Can software subscription service prepayments be written off? And so depends on, well, Lewis, what's the short answer to that?
So if they prepay for a service, then that's an expense. Then yeah, I mean you could expense it as a cash basis taxpayer, not if you're full accrual.
So if I'm on a monthly subscription for certain software and I'm having a good year, I'm going to pay my tax, I'm going to have a high tax burden, I could in December say, hey, let me get off the monthly, let me just pay the next year up front right now. And so if so what would that mean if let's say I was paying $100 a month for my subscription now and I paid $1,000 in December to prepay the next year? What does that essentially save me in my tax?
300. So so it really comes down to your tax bracket, right? So, and I like to use just easy numbers for the math. So if you're making $100,000 net income, not top line. So if you have a $500,000 business, And that's another tax benefit you want to do. You want to pay yourself a low salary, market salary. You want to pay yourself 40,000, 50,000. Otherwise, you're going to be taxed on all your profit. To Lewis's point about a Schedule C being taxed at Social Security, and you'll pay 15.3% for Social Security. So you want to have a small salary. Then what you want to do is the rest of it is owner distribution. So if you have $100,000 in profit, you're going to be on the hook for 30% roughly. And so if you have $1,000 that you can prepay into next year, you're really giving yourself a $300 return on your cash. Now, to Lewis's point, he said you can't be full accrual. And so there's cash basis, modified accrual, and full accrual. And if you are less than $10 million in size, or let's go even a little lower, less than $5-6 million in size, you do not need to be a full accrual basis company. You're going to be much better off as a cash basis or modified accrual. Modified accrual is where you're not writing out, schedules for everything and everything being accrued to when it happens. Modified accrual is, say you prepaid your insurance for the whole year and you want to show it on your P&L as an increment. Say it was 24,000, you want to show 2,000 a month, even though you took the 24 out of cash, to help you understand your net income. And that's modified accrual. So all day long, prepay anything that you can. Don't put yourself in a bad financial cash flow position for January, but think about this in terms of how do you take the government's money and put it into your business and hang on to your own money? Because what we hear time and time again, Sean, is we hear from customers who say, my business makes good money, but I have nothing to show for it. And it's because the money is sitting in receivables, the money is sitting in inventory, and the money is being paid to Uncle Sam.
Yep, I can vouch for the inventory part of that.
Yeah.
Okay, we have a question here from Sean McShane. Can you explain the difference in taxes in buying a 6,000 pound truck and buying a less heavy van, i.e., for example, buying a 50,000 van, which can't be purchased over Section 179, over a $100,000 van, assuming more than 100K in profit? So I guess the question there is, when is it more beneficial to, let's say, and I think one important detail is it's 6,000 pounds GVR, right? Which is a little bit different than the actual curb weight. But what is the trade-off between, okay, let's say I'm going to buy like just a regular minivan that, let's say, weighs 5,000 pounds for $50,000, or I'm going to buy the Sprinter, which weighs 66,000 pounds for $100,000. Is there a point at which, you make that decision to jump up and pay the extra amount for the heavier vehicle because you get so much tax savings? Like, what would that cutoff point be?
So if you buy a vehicle for less than 6,000 pounds, then the limits are like around $20,000 for first year depreciation. So the delta there between 50,000, the cost, and the 20,000 of tax deduction, that $30,000 times your, let's say 30%, right? $9,000. That's how much tax savings you're losing, but you're saving 50,000 by not getting a bigger truck. You're saving $50,000 in cash. So to me, if you don't need the bigger truck, in that scenario, that's a no-brainer. You get the smaller truck.
But Lewis, what about a bonus depreciation on that? So would bonus depreciation work on that $50,000 van?
Only if it's over 6,000 pounds.
So for business,
vehicles are not the same as, equipment for bonus depreciation.
Okay. Got it.
I have a question. This is kind of outside of Section 179. But I know a lot of the business owners here are kind of small business owners, owner operators. Is there anything, like, let's say your wife helps you in the business, your kids help you in the business? Is there any like tips there that people can take advantage of as a business owner?
Yes. So if you have kids that are under 18 and you want to pay them, you can pay them up, and they don't make any other income. You can pay them up to the standard deduction, which is like $18,000. And you have to have a family LLC, just a single member LLC that you file with your personal tax return. You could pay each kid up to, roughly $18,000. And that's a straight tax deduction for your business, for your LLC, and for your regular business with the keys. And there's no W-2, no 1099 to your kids. It's called outside labor. So, if you want to learn more about that, just contact us and I can definitely walk you through it. But yeah, that's very powerful. Many small business owners, we've helped take advantage of that one.
And I will say, and thank you, Louis, I will say that traditional CPAs do not give you this information on a regular basis because it's extra forms and it takes a little more time, complicates the tax return a little bit. But it's a way to save a ton of money. It's 100% write off to your business and it's tax-free dollars. And you can do that. So if your kids are small and young, you're going to have that for years and years. It'll more than pay for the accounting that you want to do with us, monthly. There's one other piece that we'll give you guys, and before we close out. And Louis, give them our favorite tax loophole, the Augusta rule.
Yeah, so you can rent your house out 14 days or less to your business for any reason, meetings, whatever, at fair market rate for your local Marriott small to medium-sized conference room. We usually take $450 or $500, and that's a straight tax deduction. No paperwork needed. You need to document what you did for those 14 days, but you can just say you had meetings or you met customers. It's a straight tax deduction.
So that's a big one. And typical Marriott's going to run $1,000 to $2,000. So that's an easy way to pull $14,000 to $28,000 down off your business. But be sure, if you had a couple of team members come on over and, have a quarterly meeting or a training or something, but you can rent your house to yourself and take care of that. So Sean, it's been an absolute treat and a pleasure to be here with you and your audience and your customers and the Locksmith on. Louis, thank you so much for jumping on. I know you just came out of tax and I saw him in the hall and I said, hey, I'd love it if you joined me. And he said, always. Sure. And he hopped right on. So thanks for all that great knowledge that you're sharing out today.
Pleasure.
Thanks, Lil. Thanks everybody for joining. As a reminder, if you have any more questions, reach out. Hopefully we helped you save some money on your taxes this year. I just learned a new one, so I've been in the weeds pretty deep on this stuff, and I just learned, I never heard that one. So this was I appreciate that. Sounds good. Awesome. Thanks everybody.
Thank you. Bye-bye.